So imagine you invoice 20,000 worth of work in December. You did the work and sent the invoice, but the payment doesn't come until January. Under cash accounting, December can look slow and January can look great. Under accrual accounting, December reflects the work that was actually done. Same business with the same work, but very different picture depending on how the books are set up. In this video, I'm going to show you the real difference between cash and accrual accounting and what it actually means for how you see your business, which method makes sense depending on how your business operates, and why this decision is worth a conversation with your tax professional before you lock anything in. But before we get into the mechanics, I want to give you a way to think about this that makes it a lot easier to understand. So think about a photographer who delivers your photos in two different ways. One version is the raw, unedited file straight out of the camera. It's exactly what was captured in the moment, nothing added and nothing adjusted. The other version is the edited file, the same photo, same subject, but it's been processed to show more detail more accurately. The colors are corrected, the exposure is right, and what you're looking at actually reflects what was really there. Both are the same shot, but one of them tells you a lot more. Your accounting method works the same way. Cash and accrual are both looking at the same business, but what they show you and when they show it to you can be very different. And depending on what decisions you need to make from your numbers, that difference matters a lot more than most people realize. So let's start with the simplest way to understand what separates these two methods. It really comes down to one question. Cash accounting answers when did money actually come in and go out, and accrual accounting answers what did I actually earn and spend during this period. That distinction sounds simple, but it really changes a lot about what your reports are showing you and when they're showing it. With cash basis accounting, income is recorded when the money actually hits your bank account, and expenses are recorded when they actually leave it. That makes it straightforward to follow because everything ties back to real movement of money. It doesn't mean your profit and loss will match your bank balance, since your bank balance includes everything from loan deposits to owner's draw and transfers that have nothing to do with your income or expenses. But it does mean your income and expenses in your books are driven by when cash actually moved rather than when the work happened or when the bill came in. With accrual accounting, income is recorded when it is earned. That means when the work has been done and you've delivered what you were supposed to deliver, not when the payment arrives. Expenses are recorded when they are incurred, not when they are actually paid. So if you receive a bill in December, but don't pay it until January, accrual records it in December because that's when it belonged to your business. This means accrual requires a little more infrastructure. You'll need to track what customers owe you and what you owe vendors. Your books are a bit more involved to maintain, but what you get in return is a financial picture that more accurately reflects what happened in your business during a given period rather than just what happened to move through your bank account. Cash tells you when money moved, accrual tells you what was actually earned and spent during that period, regardless of when the money moved. Those two things are related, but they are not always the same. And before we go any further, I want to make one thing clear because this trips up a lot of people. Cash basis and accrual basis accounting are not the same thing as cash flow. Cash flow is a separate topic that looks at how money was actually moving in and out of your business over time, and we will get into that in another video. The accounting method is simply about when income and expenses get recorded in your books. Those are two very different things. Cash accounting is simple and there is real value in that simplicity, but it has some limitations that are worth understanding because they can lead you to make decisions based on a picture that isn't quite accurate. The first one is timing distortion. Cash can make a good month look bad or a bad month look great, depending purely on when payments happen to land. And that's not always a reflection of how the business actually performed. Here's a straightforward example. Let's say that you prepay 6 months of software in January. Under cash accounting, January looks like an unusually expensive month, and the next 5 months look artificially profitable because that cost already left the account. But the reality is that software is serving your business every single month. Accrual would spread that expense evenly across all 6 months because that's where it actually belongs. Cash just dumps it all in January and moves on. The same thing happens with income. If you do a ton of work in 1 month, but clients pay slowly, your books can make that month look weak, even though it was one of your strongest. And the months the payments finally arrive can look great even if you barely worked. That timing gap can really distort how you read your own performance. The second issue is what I call the bank balance illusion. A business can look perfectly healthy on cash basis because money is coming in faster than bills are going out. But that doesn't mean margins are strong or that pricing is right. It just means the timing is working in your favor right now. Once you look more carefully at what was actually earned versus what was actually spent to earn it, the picture can actually look very different. And the third thing cash misses is work in progress. If you invoice after the work is done, deliver a project over several months, or take a deposit up front, cash doesn't reflect what is actually happening in your business at any given point. The work is real, as well as the cost, but the books don't show any of it until money moves. None of this means cash accounting is wrong. For the right businesses, it's actually a perfect and appropriate choice, but it is worth understanding where it falls short so you know what you are and aren't seeing when you look at your reports. Accrual accounting takes more work. There's not really a way around that, but the reason it's more complex is actually the same reason it's more useful. It forces you to understand harder questions about your business. When was the work actually done? What expenses belong to what work? What do customers still owe you? What do you still owe vendors? Those questions actually take more effort to track, but the answers give you a financial picture that more accurately reflects what's happening in your business, rather than just what happened to move through your bank account. So, what do you actually get for that extra effort? The first thing is more accurate profitability by month. Instead of guessing whether a month was good or bad, based on what landed in your bank, you can actually see what you earned and what it cost to earn it during that specific period. You can see if your margins are improving over time. You can see if expenses are creeping up. You can see whether your pricing is actually working. When your reporting is distorted by timing alone, you can easily misread how the business is performing and make decisions based on a story that isn't really true. The second thing is better decision making in real time. With Accrual, you can see that a month was profitable even if the cash hasn't arrived yet. That changes how you think about whether you can afford to hire, whether you should take on more work, or whether something in your cost structure needs attention. You're making decisions based on performance, not on the timing of when payments happen to land. And the third thing is that accrual tends to become more important as your business grows. If you carry inventory, extended payment terms to clients, or want to bring on financing or investors, accrual usually becomes the right choice. As your business grows and you start thinking about financing or bringing on investors, accrual-based financials tend to give lenders and investors a much clearer picture of how the business is actually performing. Cash-based books don't always tell you that story as reliably. The complexity of accrual isn't a bug, it's really just a trade-off for getting accuracy. And for a business that is making real decisions from its numbers, that accuracy is worth a lot. This is one of the most misunderstood areas when it comes to accounting methods, and it's worth spending a little time here because it confuses a lot of business owners, especially those in product-based businesses and restaurants. Here's the key thing to understand. Under proper inventory accounting, inventory is not really an expense when you purchase it. It becomes an expense when you actually sell it. That's what creates cost of goods sold, or COGS as you'll often see it called. So what does that mean in practice? Let's say you purchase $50,000 worth of inventory in January. On a pure cash basis approach, that entire amount would hit your books as an expense in January, the moment you pay for it. So January looks like a massive loss, even if you haven't sold a single unit yet. Then as you sell that inventory over the following months, your books show strong profit because the cost already left in January. The timing is disconnected from what actually happened in the business. Under accrual, the cost of that inventory doesn't show up as an expense until the inventory is actually sold. So the cost matches the revenue it generated. January reflects what was purchased. The following months reflect what was sold and what it cost to generate those sales. The picture is far more accurate. For restaurants and coffee shops, this is especially important. If you want to understand your food cost percentage and your true profitability month to month, you really need your cost of goods to match the period the food was actually used in. Cash basis tends to struggle to give you that reliability. And without that level of accuracy, it's pretty hard to make confident decisions about your menu pricing, your ordering, or your margins. So if your business involves inventory or cost of goods in any meaningful way, accrual is usually the method that's going to serve you best. From a managerial standpoint, it's typically the approach that gives you a financial picture you can actually use. Just keep in mind that the IRS does allow some small businesses to use cash basis for tax purposes, even when inventory is involved, depending on revenue thresholds. So the way your books are kept and the way your tax return is filed can be handled separately. We'll come back to that in a minute. So now that you understand how each method works and what each one gives you, the real question is which one is right for your specific situation. Here's a simple way to think about it. Cash accounting tends to work better when you get paid immediately at the time of sale. You have no outstanding invoices sitting unpaid, you carry no inventory, and your operations are relatively simple. A solo service provider who gets paid the same day they do the work and has no products to track is a good example of someone who can function well on cash basis. The simplicity serves them and the limitations don't really affect them. Accrual tends to become more valuable when you invoice clients and payment comes later. You have ongoing projects or retainers where work happens over time. You carry inventory or have cost of goods sold that need to match your revenue. You want to review your numbers regularly and make real decisions from them, or you are planning to grow higher or eventually seek financing. If any of those things describe your business, accrual is likely going to give you a much more useful picture. But here's the most honest way to frame this decision. It comes back to that question we started with. What do you need your numbers to answer? If you primarily need to know when money has come in and gone out, and your business is simple and straightforward, cash can work. If you need to know what your business actually earned and spent during a given period, whether your margins are healthy, whether your pricing is right, and whether you can make confident decisions about growth, then accrual is probably the right tool. It's not about which one is easier, it's about which one is actually serving you and your business. And one thing I really want you to take away from this is that once you choose a method, changing it later is not a simple switch. It requires a real reason to make the change, and it involves restating your financials, which is a significant undertaking. So this is not a decision to make casually or just because it seems easier right now. Take the time to think through where your business is headed, not just where it is today, and make the choice that's most likely to serve you as you grow. And one more thing worth saying here, your books and your tax return don't have to use the same method. It's pretty common and perfectly acceptable to keep your books on accrual for the clarity and accuracy it gives you while your tax professional handles the filing side in whatever way makes the most sense for tax purposes. Those are two different purposes and they can be handled differently. This is exactly why having a conversation with your tax professional before you decide is so important. They can tell you what makes the most sense from a tax perspective, and you can make sure your books are set up to serve you the way that you need them to operationally. So cash and accrual are not just different ways to do accounting. They are two different ways of seeing your business. And the method you choose shapes the story your books are telling you every month. If the story's off even slightly, the decisions you make from it can easily be off too. Cash answers the question of when the money came in and went out. Accrual answers the question of what did my business actually earn and spend during this period. Those are two different questions, and depending on what decisions you need to make, one of them tends to give you a much clearer picture than the other. And remember, this is not the same thing as your cash flow. That is a whole separate conversation for another video. This is purely about when your income and expenses get recorded and what that means for how clearly you can see your own business. If you aren't sure which method is right for you, talk to your tax professional before you decide. And once you make that decision, make it with the long term in mind, because changing it down the road is not something you want to do without a very good reason. Now that you understand the difference between cash and accrual accounting, the next step is understanding who should actually be handling your books and what their role really means for your business. So click right here to watch that video.